All right. Matt, the mortgage guy, live Monday Q&A, 3 p.m. Pacific Standard Time. I'm here to answer all your mortgage real estate questions in an honest and straightforward way, because that's what you want. That's what you deserve. And I'm here to tell you that I've got some, I don't know if I'd call it disturbing, but something I'm going to talk about today, and I'll get into it maybe a little bit later. Maybe I'll wait for a break and questions to get into it. But I'm going to record a video where I've got 5 examples, which is wild to me. 5 examples in like the last, let's call it 3 or 4 days, where clients didn't like the answers we had for them as far as what they'd qualify for and how much they're able to buy. So they went and they were seeking answers elsewhere. The problem with that is that we're doing all our due diligence. We're doing a complete job when it comes to a pre-approval. If you're qualified for 550 based on your specific scenario and somebody else tells you 700, not always the case, not always the truth. Oh, they didn't realize they had to calculate this collection account this way. Oh, they didn't realize that, FHA, they got to take into account your non-borrowing spouse's debts. Whatever the case may be, people are doing that. And I already know, I've seen how this plays out, right? You go and you ask the question until you get the answer you want, which is 700,000. You have an agent write an offer, you get into contract, you pay for an appraisal, you pay for inspections. 3 weeks in, they go, oh, shoot. Forgot that one thing. Yeah, I guess that 550 cap that other lender talked about was because they've seen a thing or two, so they know a thing or two, and they were right. We can't get this loan done at 700. But you told me, you said I was pre-approved. A lot of this is more, in my opinion, the fault of the half-ass lender more than it is a fault of the consumer. It's natural for a consumer to say, man, I really want to buy in this neighborhood. I really want to buy at this price. I'm going to go seek out a second opinion. The problem is the second opinions are lower in quality today, maybe because there's more lenders out there, maybe because some of the lenders are desperate for business. Whatever the case is, I'm seeing more of it, and it's wild. I'll give you guys some specific examples later. I do want to jump into some questions because I love it when you guys ask questions, and I want to get them answered before these folks have to go off and have dinner or leave the office or whatever the case may be. So familiar face, my buddy Ryan Lundquist. Good to see you here, brother. I don't know if you're watching every week, but I reference you, Sacramento Appraisal blog, some of the data that you put out all the time. So I appreciate you continuing to do that, providing a ton of value for not just Sacramento and surrounding, but countrywide. I'm sure people can glean value from SacramentoAppraisalblog.com. So what are you seeing with the level of mortgage applications right now? Refinance and purchase, both. I think every week we get a number that's like the prior week, and it comes out on Wednesdays. Mortgage Bankers Association comes out with the application number. Last Wednesday, when it was actually talking about, week ending, whatever that was, February 17th, mortgage applications were down something like 16% on refinance and 10% on purchase. I think that's the numbers that I recall, which, as you know me, more so off of how I'm feeling and what I'm seeing in my own business is how I kind of judge which way the wind is blowing versus the data. But the data supporting what I'm seeing. Refinance volume is down a ton, and it makes sense because there's just less people that are in the money or seeing a true net tangible benefit from a refinance, especially on the rate and term side, where all you're doing is refinancing to save money. A lot of those, truth be told, have just evaporated. If you refinanced in 2020 or 2021 and you went from 4% to 2.75, or you went from 3.875 with mortgage insurance to 2.875 without it, there was enough benefit to where everybody who kind of did, right? Now, rates have ticked up without paying points. You're going to be in the high 3s on a 30-year fixed rate conventional loan. There's just not enough people at 5% or 4.75 or whatever the rate would need to be for it to make sense for the rate and term. All the refinances that are going on now, and I shouldn't say all, I should say most, are due to an event, divorce or death or something where a refinance has to be done, or a cash out for home repairs, debt consolidation, other investments, right? So those are still going on, but nowhere near the number of refinances we saw in 2020 and 2021, just because there's just far less where it makes sense. So that's to be expected. I really think, Ryan, that there's still a ton of purchase demand. As you know, January and February aren't super hot months for people to go out there and get pre-approved and buy. It feels really competitive. It is really competitive, but like we shouldn't expect there to be a ton of inventory on the market in January and February because there's not usually. And I think the year-over-year number is like 20% less than normal even. So you pair that with all the demand, even with applications being down 10%, there's still a lot on the demand side. We're still processing 50, 60 completed applications per month in my office, which is, still a lot of people willing and able to buy. This recent uptick in rates hasn't like demolished purchase demand. It's barely had a dent in purchase demand, to be completely honest. Whereas a 1% uptick in rates for sure is going to have 65, 70% decrease in refinance volume this year. I heard a stat that in the last 20 months, something like 60% of the whole universe, the whole conventional loan universe had refinanced, right? That's pretty crazy to think about. Like 6 of 10 conventional mortgages were written in the last 20 months and only 40% were written before that, right? So that's kind of a wild number to think about. And it lends to the fact that tons and tons of mortgages are written. That number is going to slow down as we would expect it to with refinance. All right, Summer, forbearance question. Thanks for tuning in. Thanks for asking this question. Forbearance is a super hot topic. A lot of folks that were entering forbearance towards the start of the pandemic are either at or nearing or just completed that 18 months, which a lot of people, did mortgage forbearance and was able to put off payments for 18 months. So now you're saying, in order to move forward with this forbearance, your mortgage company wants to put a lien on your house. And you're asking, should I sign? My best advice is if it's, there's a difference between a modification and just like an agreement when you're exiting forbearance, but you just want to make sure that you read and you understand what you're getting into. For the most part, they're trying to do right by people, and they're, lowering your rate. They're putting this balance, you might owe $27,000 or $32,000 after not paying for 18 months. They're putting this balance basically as a lien on your house. Like you said, that's not anything you should be necessarily afraid of. It's just how they do it. I'm pretty sure that's how they do on all the government loans. FHA turns it into a second lien and puts that on your house, so that if you refinance in the future or you pay off your home, you're going to have to pay off that balance due. And then your first mortgage, they're going to do some sort of modification, some sort of agreement where, you start paying on that again. So just read it, make sure that, it makes sense. I haven't seen any of them where like your terms are getting worse. It should only be getting better, but make sure that you're reading that stuff. And then here, calling it a loan modification agreement. Yeah, that's what a lot of servicers are doing. So have a second set of eyes review that for you. I don't know if I'm the expert on loan modification agreements, but if you wanted to go to greatmortgagebroker.com, fill out a form, have somebody from our team take a look, be happy to do that. Good evening, Kevin Hawthorne from Florida. Thanks for joining, man. Appreciate you. Miss Taylor, welcome back. It's been a minute, but you're back. So I appreciate you being here. Let me know if there's anything that's on your mind, anything you're thinking about. Be happy to answer those questions for you and get into some good chats on anything real estate, anything mortgage. There's a lot of stuff. Every time I have a good conversation, I think to myself, that would be something good to bring up online. And on that subject, I'm seeing more and more contracts than ever before, because even if we're only getting 15 or 20 accepted every month, trust that 200 are being written. I'm telling every single agent we work with, please CC me on the offer. Please let me reach out to the list side. Please let us be involved to help in any way possible, because I know as well as anybody, it's a crazy, insane, competitive market. Anything we can do to gain an advantage. What I get out of that is I get to see a wide spectrum of the best presented offers with the best terms, the best agents, well-crafted emails. I get to see the best of the best, and also some not so great offers, to be completely honest. I don't want to throw an agent under the bus, but you can certainly be out there home shopping, submitting offers. And as a consumer, you don't really know the difference. And so you have no shot, and you might not necessarily know it. Your agent, it's not always negligence. It's sometimes they just don't know. They don't have enough practice. They don't do it enough to where they truly know how to structure a great offer. Mediocre offers aren't getting accepted. Half-ass offers, not getting accepted. This is a market where the best offers are not always getting accepted. You've got to put in amazing offers. And then when you're one of those three, you're going to have a couple things that differentiate you. Your lender reached out, let the seller know, and gave him a lot of confidence about this thing closing quick. You were able to talk to the listing agent and say, hey, listen, I'm easy to work with. We're going to get to the finish line. We're going to do it together. Everyone's in this, together, and we're a team. I love communicating throughout the process, and whatever the case may be, whatever the pitch is, right? Like, that stuff matters. And some stuff I see, if I'm being completely honest, it's an exercise in signing a contract for the buyer. There's no chance the thing gets accepted. Either the agent hasn't called and extracted the information from the list side, or they don't understand, hey, this house on this street listed at this much, writing at 582 is not going to do it, right? I can look at some of that stuff, and I'm not going to tell that to the agent. Great agents I have great relationships with, I could offer some constructive criticism or feedback, and they'd take it. Ones who aren't necessarily partners, I don't know. That's another thing too. What do you do? What do you do in my spot? Call an agent and be like, listen, you got to step your game up. That probably wouldn't gain me any more friends. Do I need that? Probably. Massive competition, Ryan. You're right. Massive competition. Frustrating, I think, for a lot of buyers. I heard a stat recently that was from interested buyer to closed on a home used to range 60 to 75 days. Hey, I'm thinking about buying a house. Oh, talk to my lender. They're great. Get yourself pre-approved. Cool. Here's an agent who's great in that area. Go out, see some houses, put in an offer or two, get some accepted, get in a home. That number versus 60 to 75 days right now, based on some metrics, big lenders, 250 to 260 days. It's almost 9 months between interested and closing on a home. That means a couple different things. One, you're not getting offers accepted. Two, I can imagine, and I see it in my business as well, get pre-approved, get excited, put in a few offers, get unexcited, get frustrated, take a break, come back. Okay, let's do it. Get your face punched in a few more times. 8 or 9 months later, you either exit or you've had it up to here. You're like, the next house I see, I'm writing strong. I'm coming in hot on the first offer. And you offer something that gets accepted because you're tired of playing games. That's part of what the market is seeing. I'm sure you see it too, Ryan, is, you're like, holy moly, like, that's crazy that house listed here got an offer up there. Buyer's tired of friggin' losing. And they're saying, well, shit, 650 sounds like a lot when this house is listed at 579. But I don't want to go in at 620, 630 and miss out, search for another 6 months and end up spending 700. Whether that's right or wrong mentality, I'm not saying that. I'm just saying maybe that's part of what's going on in people's heads. Could be. All right, Kim L., thanks for joining. Appreciate you. Appreciate everybody who took a little bit of time from their Monday afternoon to come chat with me. I appreciate you. So, Kim L., job transfer, relocating, buying out of state soon, same employer, same job title, but $8K a new salary. Do I pre-approve with old or new salary? You can pre-approve with the new salary. The lender's just going to want to see either, when you first start a job, it's a job offer letter. While you're in the same position and you get a bump up in pay, they might provide you something with, hey, starting March 1st, 2022, this position of yours is going to pay $8,800 per month versus $8,000 per month. And whenever you get that, along with a couple pay stubs at that new pay, we're able to use that income because it's salary. Salary, W-2 is the creme de la creme as far as lenders are concerned, just because for Fannie and Freddie, it's sellable and it's easy to verify and calculate, right? $8,800 a month is pretty easy to figure out what you're going to get paid next month and the month after. It's $8,800 a month because it's salary. So, pre-approve at the new one. If you need it, the case with a lot of folks is, sometimes they get worried about, well, what about this and what about that? And I look at it and I go, listen, you're buying something about $700,000. Like, we can look at your income a couple different ways. We could submit this, we could do that. That would be the difference between qualifying for 1.2 million and 1.4. But you don't need either. You don't need that. Your base income is going to qualify you for the 700,000 you want and a lot higher than that. So if it matters, right, then you can provide documentation with the new salary to give you that bump. But most people, my advice, we're not trying to find our max that we qualify for. That's the wrong game to play. Not trying to stretch yourself. I've seen a lot of that right now, a ton of that. I'm seeing people that are like, hey, listen, if you can't pre-approve me for 1.2 million, I'm going to go find somebody who can. And the truth of the matter is, based on the information we have, not only does the person not qualify for more than, let's call it 1.2, just a random scenario, they shouldn't be buying higher than that. Don't wrap yourself into a $6,700 a month mortgage payment when you got $12,000 a month in income. It's not something that makes me feel good in the tummy area when I'm seeing people do that. All right, higher rates, it shouldn't affect demand, but should alter affordability. Well, it should affect both, truth be told, because demand and affordability should have some correlation. As rates go up and prices go up, that causes affordability to go down. Less people are going to qualify. And some are going to choose not to buy or simply not be able to buy because they don't qualify or can't afford what's currently available in the market. What's going on right now, though, is that supply versus demand is so imbalanced that if you've got 100 people that want 20 things and you say this thing is going to become a little bit more expensive and now only 90 people want those 20 things, there's still 90 people that want the 20 things, right? Last 20 iPhones on earth and they're, $1,350. And there's 100 people in line to buy these. They stand up and they go, you know what? The iPhones are $2,000 now. If 90 of the 100 people still want to pay $2,000 and they're going to stay in line and they're not going to say, forget this and walk off, we're still going to have a supply versus demand problem. And that's what's going on. Truth be told, people that are pre-approved and ready to roll and can afford $600,000, if that house goes to $650 and the rate goes from $2,875 to $3,875, in the future it goes to 4,375 to 4,875. If those people still are able to afford that 600 and they're willing and able to buy, that demand is not going away. It'll be interesting to see where the tipping point is, right? Because somebody asked that today on some call I was on about when rates get to 4%, this happens. And I said, well, they got to 4% and that didn't happen. But at 4.5, will there be some, like point where people slow down? There's always going to be people that want to buy, but what is the rate? What is the price? Where does that affordability get stretched enough to where 30-40% of the buy side says, nah, we're good? I don't know. We're going to see. We going to see. Thanks, Summer. Appreciate you. Jeanette. Well, thank you for asking. I'm doing great. I'm feeling good. A little bit tired. But all in all, family's good. Got my health. I'm trying to look up this TikTok because Joey brought it up. You know what? I won't get distracted. Looking it up, but thanks for asking, Jeanette. I'm doing well. I'm doing good. I was skipping ahead. I got distracted because Joey Garessi was talking about the TikTok. If you enjoy TikTok humor as much as I do, go check out Matt the Mortgage Guy on TikTok. I made one today poking fun at myself, to be honest, myself and other mortgage professionals that are out there chasing real estate agents. It was the Hello, that Adele song. How are you? Basically, all lenders are calling realtors day in and day out, trying to fill the purchase pipeline of their business because the refinance pipeline of their business has dried up significantly. Remind me later in this video to talk about refinance a little bit too, because I got some interesting data on who's refinancing, what company is refinancing them, and why I think it's really, really bad. It's a really bad sign for who's it a bad sign for? The company, the consumer. It's scary. All right, we'll talk about that later. All right, this is a popular question. Harshal, thanks for joining. I appreciate the question. A very common one, and I'm going to try to answer it as simply as I can because that's what my channel is about. Let's keep it simple so as many people as possible understand it. Because a lot of times people will talk yield, spread, premium, and paying points, and it just doesn't sink in. So you want to know what's the relationship between points and rate. How many points will a quarter percent in relation, depending on credit score or something? Like, I get what you're saying. And here's what I want to tell people. On every scenario, it's going to be different. You cannot say that 1 point equals a quarter percent in rate across the board. It's not how it works. Investment property, one rate sheet. Primary residence, another rate sheet. Second home, a rate sheet. 20% down, separate rate sheet. 30% down, 5% down, 10% down, 2 unit, 4 unit, single family, 1,000 different scenarios. Every single scenario you have, you've got different data points. You've got 760 credit score. You've got primary residence. You've got, even zip code plays into it, right? Because you might have different rate sheet for a different zip code. You do that and, based on 30-day lock, 45-day lock, you're going to get the whole rate sheet. And let's just, for example purposes, say 3.875 is the rate with no points. You can pay points, meaning pay up front. My buddy Kyle Seagraves, Win the House You Love. I like how he refers to it as prepaid interest. I think that's a good way to look at it. So you prepay this fee, these points, to get a lower interest rate up front. Prepaying interest. I like that, Kyle. I really do. I'm looking at a rate sheet right now, and the difference between 3.875 and 3.75 is 55 basis points, 0.55%. Then you go to 3.625, and it's about exactly 100 basis points. So in this case, it's 1 point, 100 basis points equals 1 point to go from 3.875 to 3.625. Just know that you go to 3.5, and now that's 45 basis points. Like, it's going to be different every increment. It went like 55 basis points, then 45, then 45. And then you go to 3.375, and that's, what is that? Yeah, it's like 198 basis points away from 3.875. So about 2 points. I might have thoroughly confused everybody, but we'll use a $400,000 loan amount for our example. 1 point is $4,000. 1 point equals 1%. So if you pay $4,000 up front, you're going to be able to lower that rate by 0.25%. If you pay $8,000 up front, 2 points, you can lower it by 0.5%. What I want people to understand is it's not always that simple of a calculation. A different scenario, it might be 2.5 points to go down 0.5%. Another case, it might be 1.5 points or 3.5 points. But that's the basics of how it works. And for your, like maybe just to kind of have a rough estimate, Harshal, 1 point is going to be about 0.25% in rate. Meaning if 3.875 is 0 points, 3.625 is about a point. In the scenario I'm looking at, that's exactly what it is. Actual demand from individuals, but probably not the corporations like BlackRock. So I guess what you're saying, Techie Tech, is you think that like higher rates is going to hurt demand more for individuals than it is for corporations and affordability, right? You may be right, because, what's affordable for $1 billion hedge fund or a $10 billion hedge fund? They don't have no affordability ceiling. They got deep pockets. I think that's what you're trying to say. I agree. All right, Harshal. Follow-up question. You just want to know the difference between 761 and 801 credit score for rate and PMI. It's going to be a very minimal difference. And truth be told, it's lender to lender. Some lenders are going to say 760 and above, everything the same. Other lenders are actually going to have pricing breakouts and different rate sheets for a 780 plus. Where you'll see that more often than not, to be honest, is jumbo. You got a 780 credit score, I've seen that bucket, right? Because that's all it is for lenders, is buckets. 760 and up bucket, 720 to 760 bucket, 680 to 720 bucket. They can bucket it every 20 points, 700 to 720, 720 to 740, 740 to 760. It's usually not going to be that specific. It'll be bigger buckets, except for on the jumbo stuff where they're a little bit more nitpicking, like, all right, let's separate them out. 720 is going to be this pricing, then 740, then 760, then 780. But for all intents and purposes, 760, 800, you got really good credit. You're going to get really good terms, about the best terms that are available in the market. All right, Jeanette, building your own home and you own the land. Can you tell us about construction homes, first-time buyer, FHA loans, Freddie, conventional loans? I don't think there's construction loans for first-time home buyers, at least not that I'm aware of. I generally do very little construction, but I've got a partner that I refer all that stuff to who's an expert in that. I'll probably connect you with Sean Hammond if you wanted to discuss different things. AFR as a company who we broker to has a lot of different construction to permanent financing and to get into detail on that stuff, I'd be half guessing. And I'd rather keep it real. So I'm just going to tell you that I'm not the expert, but if you want to talk construction loans, get into as much detail as possible about that, I've got the guy in Sean Hammond. And so go to greatmortgagebroker.com, fill out the quick form. Let me know what state you're in, what you're looking to do. We'll get you on the phone with Sean Hammond. He'll be able to help you out. Jamila, is that it? Apologies. I'm not the best at pronouncing names. I'm really good at numbers, like reading and pronouncing and all things English class. Not Matt the Mortgage Guy's cup of tea, right? So apologize if I mispronounced it. In return, to make up for it, I'd be happy to review any sort of loan scenarios you're looking at and give you honest advice. I was talking to a senior leader at UMortgage that told me, you know what you should track, Matt? You should track your nose. Or you know what? Maybe that was Mike Zuber. Maybe it was Zuber that was telling me I should track my nose, because there's been a lot of them, right? I take some pride in giving somebody a no that's in their best interest versus trying to figure out a way a refinance makes sense to them. Something you won't get at a big box lender, something you won't get by calling a call center that has like sales numbers to hit. I promise you, you reach out to me and my team, we're going to give you honest advice. If it doesn't make sense to refinance, we'll tell you so. So if you got something already, feel free to, if you want to skip the line, just send it to me directly, matt@mtmg.com. Just say, hey, Matt, please take a look at this loan scenario, this loan estimate. Tell me if it's a good deal. Here's what I'm looking to do. If you don't have one of those, you can always ping us and say, here's what I owe. Here's what I'm looking to do. We'll put together some loan scenarios for you right now. But yeah, either way, more than happy to help. Just get in touch with me and the team, either by pinging us with an email if you got a loan estimate, or go to greatmortgagebroker.com. Let us know where you're at and how we can help. It's a great question, Ryan. And anybody who doesn't know Ryan Lundquist, he's an appraiser, SacramentoAppraisalBlog.com. Quick shout out. I just had this conversation with a buyer who was asking me, hey, what do you think it's going to appraise at? Just my glancing knowledge of what I'm seeing in my office, Ryan, because I'll be honest with people, I'm not digging into each appraisal and saying, oh, how does this look compared to the comps? Or how does this look compared to what we thought it was going to come in at? I'm just like, with a lot of loan volume going on, oh, that one was in contract at 450, appraised at 450. That was in contract at 595, appraised at 595. I'm seeing a lot of stuff appraised at value. I mean, knock on wood, I feel like I'm on a run where at value as is might have been the last 8 or 10 orders that came in over the last couple of weeks. So I'm seeing definitely a lot of stuff come in at value. You said lower or higher. I'm definitely not seeing higher. Nothing's coming in at 525 that we got in contract at 480. I can't remember the last time I saw that, to be completely honest. Trying to think of when we saw one. I mean, I've had all these removing the appraisal contingency, willing to do a $50,000 gap. We expected it to come in light, and it didn't, right? A couple of them, truth be told, I didn't bother to look in there and go, hey, did they pull a comp from another zip code? Where did they get, this one to appraise for 580 when we were looking at the solds at the time of getting the contract and nothing had sold over 540. I haven't gone into that much detail, but overall, I'm seeing stuff appraise. And nothing really weird lately, except for that. I mean, if I would say the one surprise is that on the ones we were expecting them to come in low, they didn't. So that'd be the only, that'd be the biggest, interesting or weird thing I've seen. Techie Tech, great question. How will VA loans keep faring compared to others with this scenario of increasing interest rates and the competitiveness of the market? VA still makes up their share. They're 6 to 8% of home loans in any market, really. And I think that more education is going out there that's kind of coaching and educating both buy agents and sell agents about, like, hey, these VA loans are strong loans, are good loans, are nothing to be afraid of. But with that being said, I'll be completely honest, the conventional 30% down with $1 bazillion to make up an appraisal gap or waive the appraisal altogether is still the leader in today's market, right? And the great part about VA loans is that they're 100% financing. And if there's a veteran who's established, has a good job, but doesn't have $100,000 in the bank to waive an appraisal contingency or make up the difference or something like that, those folks are still having a hard time on all government loans, really, VA, FHA, all of it. But I think that, as rates increase, if the market softens or slow down a little bit, VA should be in a better position than it's been historically, just because people are getting more educated about VA loans, how good they are, how strong they are, how sellers should not be afraid of VA loans and they should be accepting them more often. So that's my hope, at least. How many more points does it cost for an investment, single family, multifamily, and refinance? Not sure if I understand the question. If it's in regards to like paying points to lower the rate, it's going to be similar to the one we went over earlier. If I didn't, if you weren't here, got to rewind 10 minutes. We talked about how much, in general, you're going to move the needle on the interest rate versus how many points you're going to pay. And I pulled up a real example, and it was about 0.25% in rate for 1 point being paid. Truth be told, you're helping out a lot. I got some things in my vernacular, I just happen to say it a lot. So I appreciate the kind words, Harshal. I really do. Thanks for joining. UWM or prime lending? I don't think prime lending has a wholesale division, do they? If they do, they're not somebody we're signed up with on the wholesale side. UWM is a great partner to all brokers. They get loans done fast. They make it easy on the consumer. They've got great rates. They've got Appraisal Direct, where we're getting appraisals back in a timely fashion. So everybody wins, right? Consumer wins, broker wins, business wins. United Wholesale Mortgage, still love them. Planning to relocate to another office, moving from San Francisco to LA, same employer. I'm thinking of buying a primary home now in LA before moving 12 to 15 months. Is it still treated as a primary purchase? Are you working out of the office? That's the whole thing, is like, is the underwriter going to buy it? Or you're saying, hey, I think the primary means you're going to live in it. If you say, I'm moving there in a year, but I'm staying here and working out of San Francisco office, that wouldn't be a primary. If you are buying in LA, you work remote, you just so happen to report to the San Francisco office, but then you'll be reporting to the LA office in a year, that's different. I mean, primary is just where are you going to live? If you're going to live in LA right now and you're working remote and you're reporting to a San Francisco office, cool. If you're not, then it's not a primary. And there's obviously in-person jobs where there can't be a 300-mile commute. But in a lot of cases, in a lot of industries and a lot of jobs, if you can work remote, you can do it from anywhere. I guess the question falls back to like, where are you truly going to live? If you're not going to live there for a year, no, you can't buy it as primary. All right, Matt Bittner, still hoping for the rate hikes. He hopes the rate hikes are still on. Everything I've heard is no more 50 bips to the Fed funds rate in March. There's too much uncertainty going on in the world, and, geopolitical madness is probably the best word to describe it. But 11 straight rate hikes. I saw that somewhere today. They might only do a quarter every time they meet, but if they did 11 straight times, no mathematician, but that's 2.75% if they did a quarter times 11. All right. Pallavi Patel. Hello. Thanks for joining. First time on a live chat. If anybody who doesn't know what ORAT stands for, one rental at a time, go check out One Rental at a Time on YouTube. My buddy Mike Zuber puts out an immense amount of content. We record interviews every Wednesday. We do 2 or 3 videos. So there's probably 100 plus videos on our playlist, but he's got like 8 to 10 experts from, Airbnb and real estate investors and landlords and all kinds of cool stuff to check out on his channel. He's got a cool book. He's got a cool course. He's helping members pick up one rental at a time, hence the name, right? And really, really cool stuff. Really great community. So thanks for joining. Pallavi Patel. That's my best guess. How about Grand Coast Capital Lender? Never heard of them. But the thing about lenders is there's a bazillion of them. Grand Coast Capital could be like a broker shop. It's got 10 people in it, and they could be amazing at what they do. Just because I haven't heard of them doesn't really mean good or bad. I'm biased towards brokers, and I work in the broker channel. I happen to think that the broker channel is the best place to get a mortgage, better, faster, cheaper. But I would I'd need more information to tell you if Grand Coast Capital is good. Because 1, you want to be competitive on price. Brokers are. 2, you want them to be responsive and great to work with, make the process, fairly smooth and straightforward for you. And I think 3rd and finally, you want them to be knowledgeable so the advice they give you is good advice, right? If you've got somebody who just doesn't know, they might not be malicious. They might not be bad intentioned, but they might give you bad advice just because they don't know, right? I like to look for real estate agents who are also investors to give the best investing advice. I like to look for mortgage brokers or mortgage broker teams who do a lot of business and see a lot of different scenarios and can say, hey, based on what I see from your scenario, here's what I've seen people do in the past. Here's what I've seen works. Here's what we think you should do. An investor like myself can say, this is what I think I would do in your shoes. I just had a conversation today with somebody who was kind of weighing different options. One of those options was conserve some of the capital for future purchase. And I said, yes, when you can get money sub 4%, let's not pour more money into this to save $170 a month. Keep that money, in the chamber, ready to fire when a deal comes along. Go deploy it on some more real estate where you're able to leverage 80% of it with a sub 4% 30-year fixed rate mortgage. All right. That's my story, and I'm sticking to it. Allie Lassie. I don't have a primary housing expense as I'm living with my parents, but I want to purchase an investment property with a conventional loan. Will that be a problem? Not always. A lot of lenders aren't going to let you use that rental property income because you don't have experience as a landlord. You don't have a primary residence. But you should, like many people should, get yourself pre-approved, talk to a great mortgage broker, and know exactly what your options are. Have that dialed in. The education is free. And once you have it all, you can make better decisions. So you talk to a great team, quick Commercial break. Where'd it go now? GreatMortgageBroker.com. Maybe this video is sponsored by GreatMortgageBroker.com. It's me and my team. Fill out that quick form. Let us know where you're at, how we can help. We'll get you all pre-approved, ready to roll, and we'll say, listen, you can buy up to $400,000 with 25% down. Here's what it's going to look like. And then you go out, find something, get to work. We'll tell you, and it's in our best interest to give you the most honest and straightforward advice we can about what you can and can't do. And then you take that information and decide from there. Yeah, you got to move. You got to move there until you can buy it as a primary. I mean, you could buy it as an investment now and move into it. They're not going to hurt you for that. You're just going to have to put a larger down payment, pay a slightly higher rate. All right. Great question, that Bravo guy. And these are questions where I'd like to think I'm giving honest advice that doesn't have anything to do with, my best interest. It's just, if I was you, if I was a consumer, what would I do? We recently got an agent who doesn't know our broker. Would that affect us in any way? I don't think so. If you've got a good mortgage broker and a good agent who are working together in your best interest, you'll be fine. A lot of times when there's a great agent who also works with a great mortgage broker and they've done a lot of business together, there's synergy there. Like it can make the client experience better because like the agents I work with know exactly what to get me, how to get it to me, who on the team needs to get it. When updates happen, there's communication lines and processes that have been built over time, right? So that can be good. But as the consumer, you get to pick your agent and you get to pick your mortgage loan originator. I've seen a lot more recently where an agent's like, you got to use my person. Sometimes that's in your best interest and sometimes it's not. Sometimes the agent is saying, listen, my person's great and I know it. And let me connect you with them because I saw you're pre-approved with your bank. We can't get an offer accepted with a bank. Like we'll just get laughed out of the building, right? It's not required. You just want the best people on both sides, right? Sometimes they're connected. Sometimes they know each other. Something that I know is a pretty common myth is that an agent refers you a mortgage pro, that agent's getting kickbacks. Like nobody, I shouldn't say nobody. That doesn't happen, right? It's illegal as can be. No great real estate agent and no great mortgage professional is doing any of that nonsense because they got too much on the line, right? They'd be risking too much to have any sort of backdoor deals going on. So the agent is genuinely referring you to the mortgage broker most of the time because they know them and they know the communication is going to be there. And if you're working with somebody else, they just don't know that person, right? So I said a lot of stuff. I don't know if I gave a straight answer. Is it better to work with someone your broker recommends or knows? I mean, maybe you can do it either way. And here's what I'll say. If you can find independently, here's the agent I really like and trust, want to work with them. Here's the lender I really like and trust, really want to work with them. Great. If you're just starting out and you only have one or the other, agent who I really like or broker that I really like on the mortgage side, have them recommend a great partner of theirs. Because usually what you're going to get is a great recommendation, especially if it's coming from the mortgage side to the real estate side. In a market like this, if somebody comes to me and gets pre-approved, I can't send you to a crappy agent. A crappy agent is never going to get you an offer accepted. A crappy agent in this market will And I'd have no incentive for that. Why the heck would I do that? Make it harder on myself? Make it harder on my team? Put you through the agony of submitting offers that aren't going to get accepted and crappy experience with an agent. So I might be biased in this regard, but I don't know. My channel, say what I want. I think you go to a mortgage broker, get yourself pre-approved. Once that's all dialed in, you ask them, hey, I'm looking to buy in this part of town. Who do you recommend? A mortgage broker that does any amount of business is going to know a lot of great agents. They're going to be able to direct you to somebody who they know is going to not hurt their reputation by doing a crappy job, right? If I refer a client to an agent, rest assured you're going to get great service, or that agent never seeing another referral. All right, that's that. All right, Adrian, thanks for joining. Are you still seeing huge delays on new homes being constructed, locked in at $299 until July, which is also the move-in date? Going to cost me $400 every 14 days after that. Worth it? Heck yeah, it's worth it. I mean, $400 is not a lot. So if it ends up being delayed by even 2 months, what's that, $1,600? You're in a 2.99. You are stoked. You know, rates are a point higher nowadays. So yeah, not a lot of explanation needed. You're in good shape. All right. Pallavi. You were asking about Grand Coast Capital. Coast Capital Mortgage. Is it a local joint, or is it like a oh, it's for like investors? Private lending. Oh. Never heard of them, but yeah, maybe. Huh. I mean, they on their website, it's like 242 million, 700 plus loans, which isn't really a lot. I don't know. All right. Another question. What happens if I contract for a condo to be delivered later this year, but the appraisal fails? By fails, you mean it comes in less than what you're in contract to buy it at? That would be in your contract. You'd have to figure out, because your follow-up question was they reduce the price, or I come with cash. In the resale market, you know, homes that aren't new construction, that's always in the contract. What's going to happen if it comes in 30,000 light? Are you going to make up the difference? So I don't know. I don't know what's written in that contract, but I would check that. All right. So nailed all the questions, crushed it. I want to go over some quick stuff as a preview to what is probably going to be a Thursday video. Like I said earlier in the video, Cali Boss, I get pre-approved first. That's what I think is best practice. Agent's not gonna be able to do much for you except for say, hey, go get pre-approved. Then we'll start looking at houses. So just start with the pre-approval, and then either an agent recommendation from that mortgage broker, or from somewhere else. But I am going to make a video hopefully tonight on this subject, because I think it's just a really good one, and something I'm seeing right now more than ever, where there's lender errors. And what happens is when people are desperate for business, or they're trying to work too fast, or they're trying to give somebody a yes answer, don't be a consumer that searches far and wide for a yes answer. You want a correct answer. You want an honest answer, not a yes. Like I said, 5 examples where we told somebody, this is the max you can buy at. They went and got a different answer somewhere else. We reviewed it, and then we reviewed it, and then we said yes. like we said, 550. We actually dug in and did some work to find out why. On one of them, they go, why did you tell us FHA and then we couldn't do conventional? This other lender approved us for a conventional loan. Well, you had a BK that disqualified you from getting a conventional loan. So you had to go FHA. This other lender sent out the pre-approval, told them conventional, showed them conventional options. They can't go conventional. I promise you. Fannie and Freddie's not changing it for this person. And we had another one where the person's buying FHA. We had a certain number. I don't know what it was. Let's call it 500. They said, oh, I talked to, somebody else that told me I could buy for 700. Well, there's a Cavers report that hadn't been pulled by the other lender, just not a very thorough pre-approval. Wife was in default on student loans. And basically we have to resolve that, right? We can't have government loans in default. Just something that was totally missed by the other lender. A lot of these where, for whatever reason, somebody is pre-approving you for an FHA loan without taking into account your spouse's debts, like that's mortgage 101. Have to run, even though they're not on the loan, non-purchasing spouse's debts. I'm not even involved in the, workup of these pre-approvals, but I remember when I learned that fairly early. So whoever's doing these pre-approvals without doing that, I don't know where the heck you came from, but you got to go back to class. Lenders missing simple stuff like income that's variable not being averaged over the last 2 years. Somebody came back to us like, well, they told me I could do this. So I'm making $5,500 a month. No, you made $5,500 a month last month. Over the last 2 years, you average about $4,200 a month. That's what we have to use, based on your pay and your work history. That's how we got to do it. So anyhow, don't be one of these people that, it's going to hurt you, not us. You go get a different answer that you like better than the true answer of this is the max you qualify for. You get yourself into contract and you're excited because it's hard to get an offer accepted, but that excitement is short-lived because you go out and you put an earnest money deposit down and you pay for an appraisal and you pay for inspections. And then 2 or 3 weeks later, they drop the bomb on you. They can't get the loan done. So avoid that, please, at all costs. Talk to a lender who is going to do a thorough job. As a consumer, do your part. Lender's going to tell you, we need an application. We need this doc and that doc and this verification of employment from your employer and this and that. And you're like, man, this is a lot of stuff. Well, yeah, we're seeing if somebody wants to lend you $500,000 to buy a house. We're not at the car dealership and we're not renting a bike down by the beach. It's a house. It's $500,000. Someone's willing to lend you and they're going to eventually do this full underwrite. Let's do it up front. Let's get you pre-approved up front, have it dialed in so don't get slapped in the mouth later and end up crying in the corner of a rental property because you thought you were in contract to buy a house and it was just because, a lender cut corners, didn't do a full pre-approval, whatever the case may be. So enough of that, enough scolding you. Just make sure that you're working with someone who's shooting you straight, right? I know some folks will shoot you straight. One last plug, greatmortgagebroker.com. Go there, fill out the form, tell them you want to do it right, get yourself pre-approved. One last question before we go. Joey Garessi, as we all know, horrible war going on in Ukraine. Any forecast how sanctioning Russia's financial system will impact mortgage rates the next few months? Obviously, this is a touchy subject, and my heart goes out to anybody who's got family or friends or anybody tied to what's going on in Ukraine. What I will say in regards to mortgage and how it affects mortgage, We've seen that geopolitical uncertainty, things going on, affect the stock market. They affect mortgage rates. We've seen, and this is kind of how it works, when there's uncertainty, people are going to put their money into things that are secure, like the 10-year treasury in the US. It's seen as a secure investment, right? That US 10-year treasury comes down, interest rates come down. The problem is lenders aren't necessarily in a position where they want to pass on those savings to the consumer. We saw the 10-year treasury down. We saw mortgage-backed securities down. Did lenders reprice for the better today? Yes. Was it a lot? No. Do I expect it to improve a lot? Not really. The long-term forecast, which really makes up a lot of what's baked into today's rates, what we expect in the future, is still that rates will go up in the future. 11 rate hikes to come. My hope is that some of these peace talks that I've heard are going to result in this getting de-escalated, them working things out. And, it's not going to be a long, drawn out war, right? Nobody knows what's going to happen, right? But I think if you're asking me the question specifically about mortgage interest rates, I don't think that anybody should count on any mortgage rate drop of any significance anytime soon. The trend upwards is still going to be the trend upwards over the next, let's call it 3 months. I think it's still, if you like it, lock it. All my alerts today, Joey, were, hey, lenders got slightly better today. They passed on a little bit, right? Tick up, 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 and then a little tick down. If you're in a position to lock, just do it. Don't go chasing butterflies, thinking that tomorrow's getting better and the next day's getting better. So that's all I've got to say about that. And, prayers with the folks of Ukraine. Thank you, everybody, for joining. Truly appreciate you. These are always really fun on my end to get in there and answer questions that I have no idea what's coming until we log in and go live. So thanks for joining. I'll be here next Monday, 3 p.m. Pacific Standard Time, and every Monday until I decide to retire from this mortgage game and ride off into the sunset. No time soon, folks. Enjoying it way too much. Al Bundy, before I log off, thanks for joining. How many people rent out their home and don't report the rent payments as income? I've got no idea. Call the IRS and ask them. Thanks, guys. Bye-bye.